In the first week of January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX vaults in just 7 days. Investing.com. That is 26% of all the registered silver, the metal actually available and legally committed for delivery, gone inside a single week. Not paper claims, not accounting entries, physical silver, removed from COMEX-approved warehouses by institutions that no longer trusted the system to hold it on their behalf. That one number changes everything about how you should read the silver market right now. By the end of this video, you will understand exactly what registered versus eligible inventory means, and why the distinction matters more today than at any point in 40 years. You will understand what the open interest figures tell us when placed against the metal that actually backs them, and you will understand why an obscure pattern in COMEX futures positioning, one that almost no mainstream outlet has covered, suggests that what we saw in January was not an anomaly. It was a preview. There is one specific thing happening in the silver market that is not yet priced into the wider conversation. Stay with this. COMEX inventory is divided into two categories: registered silver and eligible silver. Registered silver is immediately available for delivery against futures contracts. Eligible silver meets exchange standards but is privately owned and not currently designated for delivery. Data track. That distinction matters enormously when you are trying to assess real delivery capacity. The headline inventory number, all silver in COMEX vaults combined, can look reassuring while the deliverable pool is being emptied. That is exactly what has been happening. COMEX registered inventory stood at 240 million ounces in April 2020. By February 2026, it had fallen to 86.13 million ounces, a decline of 64.1% over 6 years. Substack. That long-run context matters. The drain did not begin last month. It has been relentless for years, and the pace of that drain has accelerated sharply. Official depository statistics from the Commodity Exchange Inc., dated February 11, 2026, confirm a single-day negative adjustment of 3,256,882 ounces in the registered category, pushing total registered silver below 98 million ounces. Vaults also reported withdrawals of more than 4.7 million ounces from the eligible category during the same 24-hour period. Coin Week. When metal leaves both categories on the same day, it is not reclassification, it is departure. The silver is physically leaving. As of the most recent available data, registered silver has declined 22.1% over the prior 30 days. The coverage ratio, the fraction of outstanding paper claims that could be satisfied with registered metal, stands at 13.7%, a level considered stress territory by the exchange's own historical standards. Paper leverage sits at 7.3 times, meaning there are more than 7 paper claims for every ounce of deliverable silver. Gold-silver. Set against those inventory figures, consider what happened in February 2026 at the delivery window. February 2026 saw 5,036 contracts delivered, equal to 25.18 million ounces, the highest February delivery volume in modern COMEX history. On first notice day alone, 1,881 contracts were delivered, 37.3% of the entire month's total in a single session. The daily average sustained across 18 delivery days was 280 contracts, or 1.4 million ounces per day. Substack. To put February in context, almost $2 billion of silver was delivered in what is traditionally considered a minor delivery month. Schiff Gold. Minor months are the ones nobody watches. That number arriving in a minor month is not normal. It signals that institutions are not waiting for primary delivery months anymore. They want the metal now. On first notice day for March delivery, February 27th, silver closed at $90.10 per ounce, with 10,526 contracts, representing 52.63 million ounces, standing for March delivery against only 86.13 million ounces of registered inventory. Substack. That leaves a margin of roughly 33 million ounces between known delivery demand and available registered stock, before accounting for any additional contracts that choose to stand rather than roll. For reference, December 2025 saw 46.635 million ounces delivered, representing 50% of the estimated free-float registered inventory at that time. Substack. The exchange has repeatedly threaded the needle, and that is a fact worth taking seriously. Here is where the counter-argument must be addressed directly, because it is a serious one, and it deserves a proper answer. The argument runs like this. Open interest is not a delivery queue. It is a live, dynamic number. Most futures participants have no intention of taking physical delivery. They will roll their positions, close them, or let them expire. The historical delivery rate is somewhere between 5 and 20% of open interest in any given month. On that math, even elevated open interest does not threaten a delivery failure. A COMEX delivery typically means the transfer of a warehouse receipt, not physical silver leaving the vault. The metal often stays in storage unless the new owner chooses to withdraw it. Open interest represents outstanding contracts, not the amount of silver demanding physical delivery. Gold-silver. That counter-argument is mechanically accurate and should not be dismissed. The problem is that it describes a normal market operating under normal conditions, and several of the conditions that make the historical delivery rate reliable are no longer present. Silver is now in backwardation, meaning the spot price is above the futures price, an inversion of the normal market structure. Backwardation often signals strong immediate demand or a supply shortage in the current spot market. Shift gold. When markets are in backwardation, the financial incentive to roll forward rather than stand for delivery weakens. Holding a futures contract that delivers into a higher-priced future is normally rational. When spot is already above futures, rolling costs you money relative to taking metal now. That structural shift changes the delivery mathematics in ways that historical averages cannot fully capture. Total COMEX silver deliveries in 2025 hit 474.4 million ounces, more than double the 202.7 million in 2024, with every single month showing higher deliveries year over year. That pattern did not emerge from unchanged participant behavior. Something in the participant base shifted. Here is what is not being put together clearly in most of the coverage. Examining CME open interest data from January 7th, open interest in the January 2026 contract rose by 1,431. Open interest in the February 2026 contract rose by 1,564. Meanwhile, March open interest fell by a nearly identical number, 2,936. FX Street investors were rolling contracts backward, not forward as is conventional, but backward, from March into January and February. The analytical interpretation offered by market observers at the time was that longs were accelerating their delivery requests to earlier months specifically because they were uncertain about their ability to obtain metal in March. Many traders chose to pay up and pull their deliveries forward by several weeks, insisting on taking those silver bars into their own custody as early as possible. Trading key. That behavior is the tell. When sophisticated market participants with information about their own counterparties start racing to take delivery earlier than they planned, that is not a futures market operating normally. The LBMA side of this story adds a dimension that the COMEX-only analysis misses entirely. In normal years of ample supply, one-month silver lease rates typically sit around 0.3 to 0.5%. By January 2026, that rate had risen to around 8%. Trading key. A lease rate is the cost of borrowing physical silver, the equivalent of an interest rate but denominated in metal rather than currency. When someone is willing to pay 8% annualized simply to borrow silver for short-term delivery obligations, it signals that obtaining immediately available metal has become genuinely difficult and expensive. In October 2025, silver lease rates spiked to nearly 40%, reflecting extreme scarcity of deliverable silver. According to LBMA data, total silver holdings have fallen nearly 40% since 2021, among the steepest declines on record. Physical gold. The October spike resolved partly because metal moved from New York to London through arbitrage. That arbitrage buying, in turn, contributed to COMEX registered inventory declining further. The global silver market is not generating new supply to replace what the arbitrage is recycling between vaults. It is redistributing the same diminishing stock. Metals Focus has estimated the 2025 silver supply deficit at approximately 295 million ounces when ETF flows are included, representing the deepest supply shortfall on record. The cumulative silver deficit since 2019 now exceeds 1.3 billion ounces. SD bullion. These are structural numbers. A single year of aggressive mine expansion cannot reverse a 1.3 billion ounce cumulative deficit. Approximately 75 to 80% of silver comes as a byproduct of copper, zinc, and lead mining, creating supply inelasticity that prevents production responses despite elevated prices. Primary silver mines comprise only 25 to 28% of global output. Crux investor. That structural fact means higher silver prices cannot simply call forth more silver production, the way they can with a primary mined commodity. The silver has to come from somewhere that is already incentivized by base metal economics, not silver economics alone. The historical parallel most often cited here is the Hunt brothers episode of 1979 to 1980, and it is worth examining honestly, both where the parallel holds and where it does not. Between January 1979 and January 18, 1980, the price of silver rose from $6.08 to a record high of $49.45 per troy ounce, an increase of 713%. On January 7, 1980, in response to the Hunt brothers' accumulation, COMEX adopted Silver Rule 7, which placed heavy restrictions on the purchase of commodities on margin. The Hunt brothers had borrowed heavily to finance their purchases, and as the price began to fall, dropping over 50% in just 4 days, they were unable to meet their obligations. Wikipedia. The collapse required a consortium of U.S. banks to provide a $1.1 billion credit line to prevent broader market failure. The parallel that holds is this: markets will eventually find an equilibrium between paper promises and physical reality, and the adjustment is rarely orderly. The parallel that does not hold is the cause. The Hunt brothers episode was the story of deliberate corner buying by leveraged private actors. Today's COMEX stress is structural, not speculative. Industrial demand led by solar photovoltaic installations consumed 232 million ounces of silver in 2024, up fivefold from 2015. Crux investor. That demand does not evaporate when a futures rule changes. It comes back the next quarter with a purchase order. The Bank of England angle here is not peripheral. The LBMA is London's primary silver clearing mechanism, and it operates as a kind of shadow liquidity reserve for the global silver market. LBMA reported a stockpile of 844 million ounces of silver in its vaults in October. Yet when 1,000 tons were requested for delivery, the market was unable to fulfill the order. Approximately 4/5 of the LBMA stockpile is registered in the name of various ETFs and is not available for sale or lending into the open market. Goldbroker.com. This is the critical distinction that most commentary overlooks. Vault tonnage and freely available vault tonnage are not the same number. The LBMA headline figure is the number that gets quoted when people argue that global silver supply is ample. The number that matters for delivery stress is the portion that can actually be moved into a delivery chain, and that number is considerably smaller. Looking at what to watch in the immediate term, the CME Group publishes its daily warehouse stock report at the end of each trading session, available through the CME's public vault data pages. The registered inventory figure should be tracked daily through the remainder of the March delivery window. Any single-day decline of more than 3 million ounces in registered stock during an active delivery period would indicate accelerating institutional demand for physical removal. The second thing to watch is the silver lease rate, as reported through LBMA forward rate data. A move back above 10% on the 1-month rate would indicate that the London market is re-entering the kind of tightness last seen in October 2025. The third and most consequential thing to watch is the CFTC's weekly Commitments of Traders report, published each Friday, which shows how managed money, hedge funds and institutional traders, is positioned in COMEX silver futures. If managed money net longs decline sharply while registered inventory simultaneously falls, that is a signal that speculative paper is being unwound without a corresponding reduction in physical delivery demand, which is the stress scenario that the counter-argument above correctly identifies as the real risk. Pulling this together, COMEX registered silver inventory has fallen 64.1% since April 2020, from 240 million ounces to 86 million ounces. Investing.com. The market is in backwardation, meaning the physical metal available today commands a premium over metal promised for future delivery, a structural inversion that weakens the normal financial incentive to roll futures contracts rather than stand for delivery. February 2026 was a minor delivery month that produced the highest February delivery volume in modern COMEX history, with nearly $2 billion of silver changing hands. Schiff Gold. And the 1-month silver lease rate on the LBMA, which under normal market conditions sits below 0.5%, rose to 8% in January 2026, reflecting genuine difficulty in sourcing immediately available physical metal in London. Taken together, the data points in one direction. The gap between the paper silver market and the physical silver market is not closing. It is widening, in ways that are visible in real-time exchange data for anyone who chooses to look. Whether that gap resolves through orderly price adjustment, regulatory intervention as it did in 1980, or more disruptive delivery stress is genuinely unknown. The data does not predict outcomes, it describes conditions. The conditions right now are historically unusual. The specific question we're thinking about for the comments is this. If the COMEX does impose cash settlement on a proportion of silver contracts rather than physical delivery, what happens to the relationship between paper silver ETFs and physical bullion premiums over the following months? And who benefits from that divergence? Think through the mechanics before answering. The sources used in this video are linked in the description, including CME Group Vault reports, LBMA data, CFTC filings, and the Silver Institute's supply-demand analysis. This video is for educational purposes only and does not constitute financial advice. Verify every figure independently before making any financial decision. 3.